Hi guys, it's me Mitch, your reporter about financial management. So what is financial management? Financial management is about managing the financing for consumption and investment. So going back to our major, nung first year tayo, financial management is not new to us, am I right? So basically, financial management is an integral part of overall management. The meaning itself says that financial management is mainly concerned with effective funds management. It is the operational activity ng isang business na responsible for obtaining and utilizing funds effectively necessary for efficient operations. So we have two sources of money. Your own money that includes the cash and savings. And the second one is the other people's money. So napaka-importante ng financial management dahil we need to decide kung kailan natin gagamitin yung pera na meron sa atin. That's why, as with all financial decisions sa ating buhay, kailangan natin isipin yung tungkol sa mga strategic consequences for future decisions. You can use your own money as a source of financing if your income is at least equal to your living expenses. If it is more, you have a budget surplus that can be saved and used as a source of future financing while earning income at the same time. If your own income is less than the expenses, you have a budget deficit that will require another external source of financing, someone else's money that will add an expense. In our banking, napag-aralan natin yung difference ng budget surplus and budget deficit. Budget surplus is you are saving more than what you spend, and that money you save will use as a source for future financing and for your lifetime. While budget deficit naman is you spend more and yung income is mas mababa kaysa sa expenses. Kaya minsan, nagkukulang tayo sa budget at times na may mga unexpected change na nangyayari, like for instances, a sudden job loss o biglang pagkawala ng trabaho. Lalo na ngayon, we are in the midst of this pandemic. And because of budget deficit, we need another external source of financing, someone else's money na makadadagdag sa expense pa natin. We want to avoid the additional expense of borrowing, pero may mga instances na mangungutang tayo o manghihiram tayo sa iba to finance our needs. Kaya yon, sometimes a budget surplus turns into a budget deficit. Or in another words, saver is nagiging borrower na rin siya. So financial management is very important dahil sa mga pagbabago, and we need to understand the choices for financing and managing cash flow para makatulong sa atin na makakreate ng mas better na strategies. Financial management decisions become more complicated when the personal and macroeconomic factors become part of the decision process. But the result is a more realistic evaluation of alternatives and a better strategy that leaves more choices open in the future. So, not just the personal factors affects our financial decisions, also the macroeconomic factors such as the expansion of the economy, the inflation or deflation, it will also affect our financial decision process. So financial management decisions, however, are difficult, but we need a better strategies to have an effective utilization of funds or a better way to finance our assets and expenses. We're going to talk about the first source of our money that includes the cash and our savings. Let's see their difference. Firstly is the cash. So we all know that cash is a ready money. We also need cash management in managing our cash flows. So pag-uusapan natin yung mga needs in managing our cash flows. So first is checking account. Most people use checking account as their primary means of managing cash flows for daily needs. Incomes from wages and perhaps from investments are deposited to this account and expenses are paid from it. So checking account simply means na this is type of bank account na used for everyday money transaction. Ibig sabihin, anytime you can easily access to transfer money and you can deposit money for immediate use. So most customers keep money in a checking account for a shorter period dahil it typically pays no interest or lower interest. Direct deposit. When incoming funds are distributed regularly, such as a paycheck or a government distribution, for employers and government agencies, it offers a more efficient, timely, and secure method at distributing funds. So meaning, direct deposit is an arrangement in which money is moved electronically into a bank account. Sample for this is yung salaries from government agencies. Yung sweldo nila is directly transferred into their bank account, and yung directly deposited money na yon is immediately available for withdrawal. Thirdly is automatic payments. Withdrawals or payments have many options. It may be scheduled to take care of a periodic payment such as mortgage or car payments. Automatic payments make sense to ease the burden of remembering kung kailan ka magbabayad ng bills mo. For example, is utility bills. So, paano nga ba tong automatic payments? So, it is done directly from your bank, and when you make an automatic payment, you can tell to the bank na i-transfer yung money mo on a set date and for a set amount para bayaran mo yung bills. Nasa sayo naman kung ano yung isa-set mong payment schedule, kung yearly ba, monthly ba, or even daily. So, ang advantage nito is you do not need to be physically or virtually present for the payment is to be processed. So, the fourth one is debit card. May be used to directly transfer funds at the time of purchase. Money is withdrawn from your account and transferred to the payee with one quick swipe at checkout. So, familiar naman na siguro tayo sa debit card. Instead of cash yung ginagamit natin pambayad when making purchases, debit card is used. So, debit card draw money directly from your checking account when you make purchase. And it is good for daily use to help you stay within the budget. Lastly is the ATM. ATM stands for Automated Teller Machine Card. It is offered by a bank allows for convenient access to the cash in your bank account through instant cash withdrawals. So, ATM provides convenience dahil nga, di ba, 24/7 service ito. Wherein pwede kang mag-withdraw ng cash into a certain limit any time of the day. And it is located at convenient places such as airports, malls, and others. So, those are the transactions related to cash activities. So, keep in mind guys na banks do make mistakes. So, kailangan mong siguraduhin na yung record mo and yung record ng bangko are accurate. And siguraduhin mo rin na yung information and yung account balance mo is up to date. So, it is important to check to be sure na the bank's version of events agrees with yours. So, let's talk about savings. When incomes are larger than expenses, there is a budget surplus. And that surplus can be saved. You could keep it on your possession and store it for future use. But then you have the burden of protecting it from theft or damage. So we save basically because hindi natin masasabi or we can predict the future. Saving money can help us become financially secure and provide safety net in case of an emergency. While the borrower has more opportunity, you the seller have more opportunity cost because you give up more choices over a longer period of time. That also creates more risk for you, since more can happen over a longer period of time. The longer you lend your liquidity, the more compensation you need for your increased opportunity cost and risk. In short, having too much money in the banks or saving money for a longer period of time, the more risk for you, and that isn't always a good thing. So now, I'll discuss to you the savings market, saving intermediaries, and savings strategies. Savings market. The markets for liquidity are referred to as money markets and capital markets. Money markets are used for relatively short-term, low-risk trading of money, whereas capital markets are used for relatively long-term, higher-risk trading of money. So here in finance, saving market is also called as trade, where there is a buying and selling of liquidity. And kapag ikaw si saver, you are the seller or lender of liquidity. And when you are the borrower naman, you are the buyer of the liquidity. So, si money market is trade for short-term lending system. Less risky siya kaysa sa capital market dahil money market ensuring that the bank maintains the appropriate level of liquidity on a daily basis. While capital market naman is longer time horizon. It is when individuals are saving or investing for a longer-term goal like education or for retirement. It allows for greater use of risk to earn returns. So, mas riskier tong si capital market kaysa sa money market dahil it has a greater potential gains and losses. So, next is savings institutions. Saving institution is also known as the financial institution, and bank is an example for this. And access to the money market is done through bank. The savings institution is a bank function as an intermediary or middleman between the individual lender of money and the individual borrower of money. So far, alam na natin to, wherein ito yung mga entities that channel funds from people savers to borrowers. Banking institutions includes retail banks, commercial banks, and investment banks. So retail banks have focused on consumer saving and borrowings. Retail banks is commonly known as thrift institutions, savings bank, savings loan associations, or mutual savings banks, and are usually private or public corporations. Credit unions is a type of retail banks. So next is commercial bank. Have focused on operating cash flow management for businesses. So in fact, sila yung mga profit-seeking institutions dahil yung function nila is tumanggap ng deposits and giving loans for investment. And they do banking business para maka-earn ng profit. So thirdly is investment banks. They focus on long-term financing business. So sila naman yung mga large financial institutions that works primarily in high finance. So special segment sila ng banking operations that helps individuals or organizations raise capital and provide financial consultancy services. Next is savings instruments. These are monetary contracts that may be created, settled, traded, or modified. Financial instruments are what we trade in the financial market. Saving instruments includes demand deposit, time deposit, certificate of deposit, and money market mutual funds. So first is demand deposit. For a saver, it typically earns no or very low interest but allows complete liquidity on demand. So meaning, ito yung money deposited into bank account with funds na pwede kang mag-withdraw on demand at any time. And si banko may pay either mababa or zero interest rate on the deposit. Example for this is the checking account. So secondly is the time deposits or savings account that offer minimal interest or a bit more interest with minimum deposit requirements. Time deposit naman is a deposit sa isang financial institution na may specific maturity date or a period to maturity. It is commonly referred to as its term. So, typically, the longer the term, the higher na or mas mataas yung interest rate na mare-receive ni depositor. Certificate of deposits. If you are willing to give up more liquidity, it offers a higher price for liquidity but extract a time commitment enforced by a penalty for early withdrawal. They are offered from different maturities, which are typically from 6 months to 5 years, and in exchange, the issuing bank pays interest. So, ibig sabihin na kapag niredeem mo yung certificate of deposits, matatanggap mo yung money that you originally invested plus with any rates. So, fourthly is the money market mutual funds, which offer a higher price for liquidity because your money is put to use in slightly higher risk investments and such as treasury bills, short-term government debt, and commercial paper, short-term corporate debt. So, mutual fund, siya naman yung with low-risk investment with the goal of earning interest while still providing liquidity. So, this instrument includes cash, cash equivalents, debt-based securities with a short-term maturity such as treasury bills and commercial papers. So, those are the saving instruments. And ideally, you would choose a bank savings instrument that offers the highest APR and most frequent compounding. APR stands for annual percentage rate. It is the rate at which your principal compound that your account earns. You can calculate the eventual value of your account by using the relationships of time and value. That is, future value is equal to present value times the product of 1 plus rate times time. So, gagamitin natin yung formula for future value na pinag-aralan na natin sa major natin na FM ng first year tayo dahil yung future value depends on the rate at which you can earn a return or the rate of compounding for your present account. So, lastly is the savings strategy. So, one strategy to maximize liquidity is to diversify your savings in a series of instruments with differing maturities. So, basically, ito yung strategiya mo para ma-maximize mo yung earnings mo from savings. So, example for savings strategy is the CD laddering strategy. So, it reflects expectations of interest rates, and it is an example of how diversifying maturities can maximize both earnings and liquidity. And also, it is one saving strategy to create regular deposits into a separate account. So, that's all for my topic.
Good day, everyone. I'm here to discuss about other people's money, credit. Credit derives from the Latin verb credere, which means to believe. It has several meanings as a verb in common usage: to recognize with respect, and to acknowledge a contribution. But in finance, credit means to allow delayed payment. Both credit and debt are form of borrowing. Credit is used to purchase goods and services, to finance living expenses, or to make payments more convenient by delaying them for a relative short time. Debt is used to finance the purchased assets, such as a car or a home, rather than to delay payment of recurring expenses. Kinds of credit. We have two different kinds of credit: installment credit and revolving credit. First, installment credit. It's an older form of credit that became popular for the purchase of consumer durables like furniture, appliances, electronics, or household items after the First World War. Usually issued by one vendor for a specific purchase. It is a type of credit that includes a fixed payment schedule for a specified duration, usually with interest until the balance reaches zero. So, installment credit, ito yung sinasabi nilang hulugan. And pag nasa SM tayo, malls, ganyan, may mga shops na nag-offer ng home credit, which is a form of installment credit. Ito yung pagbibili ka ng isang item, specifically phone, ganyan. Magbabayad ka ng down payment, and within 6 months, kailangan mong bayaran yon ng buo. Tsaka may fixed payment yan na babayaran mo monthly. And second, revolving credit. Revolving credit extends the ability to delay company, typically through a charge card or credit card. The charge card must be paid in full in each period or cycle, while the credit card may not be requiring only a minimum payment. The credit is more recent form of credit. The first charge was the Diners Club card issued in 1950. The first credit card was the Bank AmeriCard. now called Visa, issued by Bank of America in 1950, which was later followed by MasterCard in 1966. Payment for different vendors up to a certain limit. Such credit is lent by a bank or finance. So, ito naman sa may revolving credit, um, na may card na siya na tinatawag. Charge card and credit card. So, we now proceed on cost of credit. Credit has become a part of modern transactions, largely enabled by technology and the matter of convenience and security. It is easy to forget that credit is a form of borrowing and thus has a cost. Understanding those costs helps you manage them. Because consumer credit is also relatively short term, its cost is driven by more risk than by opportunity cost, which is the risk of default or the risk that you will fail to repay with the amounts advanced to you. The riskier, the riskier the borrower seems to be, the fewer the source of credit. The fewer sources of credit available to a borrower, the more credit will it cost. Measuring risk, credit ratings, and reports. How do lenders know who the riskier borrowers are? Siyempre, ang pangit naman magpautang kung yung taong papautangan mo hindi marunong magbayad, di ba? So, yun. Credit rating agencies specialize in evaluating borrowers' credit risk or default risk for lenders. The evaluation results in a credit score, which lenders use to determine their willingness to lend and their price. 5 factors that determine your credit score. First, your payment history. Second, amounts you currently owe. Third, the length of credit history. Fourth, new credit issued to you. And the last one is the types of credit you have received. The rating agencies give your payment history the most weight because it indicates your risk of future defaults. The credit available to you is reflected in the amounts you currently owe or the credit limits on your current accounts. This shows how dependent you are on credit and whether or not you are able to take on more credit. Generally, your outstanding credit balances should be no more than 25% of your available credit. The length of your credit history shows how long you have been using credit successfully. The longer you have been doing so, the less risk a borrower you are, and the higher your score becomes. Credit ratings agencies pay more attention to your more recent credit history and also look at the age and mix of your credit accounts, which shows your consistency and diversification as a borrower. The credit rating process is open to manipulation and misinterpretation. Many people are shocked to discover, for example, that simply canceling a credit card, or even for a dormant or unused account, lowers their credit rating by shortening their credit history and decreasing the diversity of their account. Yet, it may make sense for a responsible borrower to cancel a card. Credit reports may also contain errors that you should correct by disputing the information. You should know your credit score. Even if you haven't applied for a new credit, you should check on it annually. Each of the three agencies is required to provide your score once a year for free and to correct any errors that appear, and they do in a timely way. If you should find an error in your report, you should contact the agency immediately and follow up until the report is correct. It is important to check your score regularly to check for those errors. Knowing your score can help you to make financing decisions because it can help you to determine your potential cost of credit. It can also alert you to any credit or identity theft of which otherwise are unaware. Identity theft is a growing problem. Financial identity theft occurs when someone possesses you based on having personal information such as your social security number, driver's license, bank account number, or credit card numbers. The impostors uses your identity to either access your existing accounts, withdrawing funds from your checking account or buying things with your credit card, or establish new accounts in your name and use those. Ito yung mga nang-hack ng account, kaya maging beware tayo dun. Using a credit card. Credit cards issued by a bank or financing company are the most common form of revolving credit. This is often has cost only after a payment deadline has passed. For example, Many credit cards offer a grace period between the time of your credit purchase or charge and the time of payment, assuming your beginning balance is zero. If you pay before interest is applied, you are using someone else's money to make your purchase at, at no additional cost. In that case, you are using the credit simply as a cash management tool. Problem arises if you go beyond using your card as a cash management tool and use it to extend credit or to finance your purchases past the payment deadline. At that point, interest charges begin to occur. Typically, that interest is expensive, perhaps only a few percentage points per month, but compounding to a large annual percentage rate. Choosing a credit card. You should shop around for credit just as you would shop around for anything that you might purchase with it. Compare the features and the cost of each credit card. Features of the credit include the credit limit, or how much credit will be extended, the grace period, purchase guarantees, liability limits, and consumer rewards. Some cards offer a guarantee for purchases. If you purchase a defective item, you can have the charge stopped and removed from your credit card bill. Liability limits involve your responsibilities should your card be lost or stolen. Installment credit. Retailers also may offer credit, usually as installment credit, for a specific purchase, such as a flat screen TV or baby furniture. The cost of that credit can be hard to determine, as the deal is usually offered in terms of low monthly payments of only or no interest for the first 6 months. To find the actual interest rate, you would have to use the relationships of time and value. Ideally, you would pay in as few installments as you could afford and would pay all the installments in the shortest possible time. Personal loans. Another source of consumer credit is a short-term personal loan, arranged through a bank or finance company. Personal loans used as credit are all-purpose loans that may be unsecured. That is, nothing is offered as collateral or secured. Personal loans used as debt financing. Personal loans used as credit are often costly and difficult to secure, depending on the size of the loan and the bank's risk and cost, screening on and paperwork. Credit trouble and protections. As easy as it is to use credit, it is even easier to get into trouble with it because of late fees and compounding interest if you don't pay your balance in full each month. It quickly multiplies and becomes more difficult to pay. It doesn't take long for the debt to, to overwhelm you. You may want to use a credit counselor to help you create a budget and negotiate with creditors. Many counseling agencies are nonprofit organizations, and that can also help with debt consolidation and debt management. Some counselors are little more than creditors trying to sell you more credit. However, to be careful about checking their credentials before you agree to any plan. What you need is more realistic credit, not more credit. Laws and regulation can govern how you behave in the credit and debt markets, but not whether we choose to participate as a lender or as a borrower. Whether we use credit to manage cash flows or to finance a lifestyle, whether we use debt to finance assets or lifestyle, and whether we save. Laws and regulations can protect us from each other, but they cannot protect us from ourselves. Thank you.
At this moment, let's proceed to the next topic entitled Others People Money or an Introduction to Debt under Chapter 7 of Financial Management. First, let us differentiate a debt from a credit because some may not know that they are differ from each other. First point is that debt is a long-term credit or the ability to delay payment over several periods, while credit is used for short-term, recurring expenses. Kung ang utang mo ay binabayaran mo sa matagal na panahon, ito ang tinatawag na debt. Samantala, kung ang utang mo naman ay binabayaran mo lamang sa maikli na panahon, ito ang tinatawag nating credit. The second point is that debt is an asset management tool used to create wealth, while credit is a cash management tool used to create security and convenience. Sa debt, ginagamit mo ito para sa pag-create ng wealth, katulad ng pagka-car loans or mortgage loans. Pero kung ipambabayad mo lamang ito sa utang, ay maaaring gamitin mo na lamang ay credit. So, after differentiating the two, let us now proceed to what lenders may face during lending. So, the lenders may face two kinds of risk, which are the default risk and interest rate risk. Default risk is the risk of not being paid. Ito ay yung totally na wala nang babalik sa'yo. Kaya minsan, ang main reason ng mga lender, kaya hindi sila nagpapahiram, ay takot silang hindi mabayaran. Interest rate risk is the risk of not being paid enough to outweigh their opportunity cost and makes a profit from lending. Bukod sa default risk na hindi sila mababayaran, meron pang interest rate risk na tinatawag ay ito yung hindi na ibibigay ang tamang dagdag para sana sa mga inutang nila. So to avoid facing default risk, let me introduce to you the default risk 5 C's, which are the character, capacity, capital, collateral, and conditions. First thing is the character or the history of the borrower. Ang mga lender, pwede nilang i-evaluate ang mga borrowers kung sila ba ay nakakabayad noon sa mga utang nila. Second thing is the capacity or the size of your income, current expenses, and current obligations. Pwede rin nilang malaman or dapat talaga nilang malaman kung ilan yung kinikita ng borrowers, kung sapat ba ito para mabayaran nito ang utang niya. Capital is the wealth or the asset base. Aside from income, pwede rin silang mag-present ng asset nila kung sakasakaling hindi nila mabayaran ito using money. Next is the collateral or the property such as securities. Sabi nga kanina sa capital, yung mga asset nila ay pwede nilang ipambayad para sa mga utang nila kung hindi kakayanin ng pera nila or ng income nila. And the last thing is the conditions or the factors like interest rate and amount of principal. Ang isang lender ay pwedeng magbigay kung anong gusto niyang interest para sa kanyang ipapautang. Siyempre, para makasiguro na rin na may kikitain siya sa pagpapautang. So, if you can avoid default risk, you may also avoid interest rate risk by using floating rate loan. Floating rate loan is a structuring loans with a penalty for early repayment to discourage refinancing. With a floating rate loan, the interest rate floats or changes, usually relative to a benchmark such as the prime rate, which is the rate that banks charge their very best. Now, after discussing the debt and who are the lenders and what the lenders may face, let's now proceed to the purpose of debt or the uses of debt. So, a debt is to finance assets